It's 10 o'clock. I'm presuming you can hear me. Please let me know on the chat if you can. But thanks for joining this virtual session, which is a joint session of ABFER and the Central Bank Research Association, or CEBRA. And I'm Frank Packer of the BIS and Asia Pacific Program Chair of CEBRA. And we're fortunate to have 4 excellent papers today, all related to central banking in some fashion, and more often than not, central banking in Asia. And we have scheduled each for presentation, discussion, Q&A. Each has 45 minutes. And the first 2 will take us to 11:30 Singapore time, first 2 papers, that is. And we'll then take a 30-minute break and start up again at midnight Singapore time. And go on through 1:30. But I think hopefully the attendees have the program in front of you and what to expect over the next few hours. But without further ado, what I'd like to introduce the presenter of the first paper. The title of the paper is Digital Money as a Unit of Account and Monetary Policy in Open Economies. And the presenter is Daisuke Ikeda from the Bank of Japan. And Daisuke, you have approximately 20 minutes for your presentation, and then we'll have a discussion and Q&A. So Daisuke, would you like to share your slides and get started?
Yeah, thank you, Frank. Let me share my screen. All right. Thank you very much for inviting me. It's my great pleasure to be here. It's online, but still it's very good to get together like this. Again, my name is Daisuke Ikeda, and the views expressed in this presentation are all mine. Okay, rise of digital money. So digitalization is everywhere around us, and money and payment systems are not an exception. Now we have hundreds, maybe thousands of digital coins and money, and there are also stable coins that seek to stabilize the price of the coin themselves. And this could pose many challenges because the use of stable coins and digital money could continue increasing and could replace the use of official currency. So this could pose many challenges in the areas of regulation, financial stability, and monetary policy, as pointed out by G7 Working Group on stable coins. But in this paper, I exclusively focus on the potential impact of digital money on monetary policy. Still, the scope is broad, so I like to limit my focus on a specific issue. So I want to have sharp questions. So in this paper, I focus on the international dimension of digital money. And here are my favorite excerpts, speech from Thomas Jordan, chairman of the Swiss National Bank. So let me read some excerpts. If Swiss franc stablecoins were to proliferate in Switzerland, this would have no immediate impact on the effectiveness of our monetary policy. However, if stablecoins pegged to foreign currencies were to establish themselves in Switzerland, the effectiveness of our monetary policy could be impaired. So here, the worry, potential problem is that the innovations of digitalization and digital money may enable pricing in any currency in any country. So in this case, in units of maybe US dollar or in euro in Switzerland. If firms and households start using US dollar or euro as digital currency in other countries, this is so-called digital dollarization. And this digital dollarization could impair the effectiveness of our monetary policy. So now we are on the same boat. So we are now looking at the potential future economy in which firms and households can set prices in units of any currency in any country without incurring any cost, thanks to the advancement of digital technology or digital money. So in this potential situation, I'd like to address 3 questions about monetary policy. First, how does digital dollarization affect monetary policy transmission, central banks' capacity to stabilize the real economy? So that's the first question. The second question is, under what conditions does digital dollarization deepen? Under what conditions do firms and households start using digital money as a unit of account and start setting prices in units of digital money? The third question is opposite to the first question. So suppose that digital dollarization has actually happened. Then can monetary policy or can central banks do something about digital dollarization? Can central banks block or maybe facilitate digital dollarization? These are the 3 questions I addressed in this paper. The approach. My approach is theoretical, based on the new open economy macro model. And I focus on a unit of account as a role of money, as in the standard New Keynesian literature. So the model I consider is a cashless open economy model with nominal rigidities in prices and wages. So there are 2 countries, home, H, and foreign, F. And implicitly, I assume that digital money or digital technology allows pricing in units of currency F, so foreign currency, in country H, home country, without incurring any cost. So setting prices in units of foreign currency in home country is frictionless and costless. Then I study this model analytically and numerically. So here are my main results. The first one is the answer to the first question about the impact of digital dollarization on monetary policy. My answer is that monetary policy becomes less effective as dollarization deepens. As more prices and wages are set in units of foreign currency, central banks' capacity to stabilize the real economy decreases. So this is my first result. The second result is about under what conditions dollarization can deepen. My answer is that dollarization is more likely to occur in a country that is smaller in size, economic size, and country that is more open to trade, and in a country that has greater tradable sector and stronger input-output linkages. In such a country, dollarization is more likely to occur. And third result is about, can monetary policy do something about dollarization? My answer is that monetary policies, both home and foreign, can affect dollarization, may be able to block dollarization. For the sake of the time, let me skip the related literature, but my model is based on new open economy macro model, and also it's heavily, my paper heavily uses invoice currency choices that are considered for local price, local currency pricing and producer currency pricing, and also dominant currency pricing. Okay. So let me move on to analytical model and implications. The model overview. The model is based on Corsetti and Pesenti, so extended to incorporate many things, such as country size, trade openness, but these 2 are highlighted by red color are important. That is, tradable goods as intermediate input and kinked demand curve for tradable goods. So these 2 factors generate price setting complementarities in such a way that foreign prices affect home country price setting, as we will see later. So these 2 are critical in considering dollarization in home country. And for tractability and simplicity, I assume that prices and wages are set 1 period in advance. So this is the form of nominal residuals. And monetary policy is also simple. Monetary policy instrument is the nominal aggregate, and all shocks are IID. So let me quickly walk you through the model. Because home country and foreign country is symmetric, I just show home country modeling. And this is household preferences, and utility depends on consumption, and also this utility from labor supply. And household maximizes utility subject to the floor budget constraint, and state contingent bonds are available, and asset market is complete. And the only difference between home country and foreign country is just the economic size. The N is the size of home country. 1 minus N is the size of foreign country. So consumption bundle C consists of non-tradable goods consumption bundle and tradable goods consumption bundle. Non-tradable consumption bundle is produced according to the standard constant elasticity of substitution aggregator, but tradable consumption bundle is produced by putting together home tradable goods and foreign tradable goods according to this Kimball aggregator, which gives rise to kinked demand curve. Okay, let's move on to farms, production side. Production side is standard. So each non-tradable good is produced according to Cobb-Douglas production function by putting together labor supply and intermediate input in the form of tradable goods. So tradable goods are needed to produce non-tradable goods, okay? And tradable goods sector, the production function is similar to Cobb-Douglas, and the inputs are labor supply and the intermediate inputs. The only difference is the demand curve because of the kinked Kimball's aggregator. So this demand curve, small g, this represents kinked demand curve. Okay. So it's very useful to consider flexible price benchmark because this is the optimal price firms want to set. So this is the home tradable goods price, P tilde, the flexible price. It is given by the weighted sum of marginal cost and the tradable price index. So without kinked demand curve, alpha is equal to 0, and so that the optimal price is equal to marginal cost. But with the kinked demand curve, the optimal price depends also on the tradable good price index. And marginal cost here depends also on tradable good price index because tradable good bundle is used as intermediate input. So kinked demand curve affects parameter alpha, and intermediate input affects this phi tau. And so these two parameters are critical in the sense that tradable good price affects the optimal price. Okay. With nominal residuals in the form of 1 period in advance price setting, the actual price is set 1 period in advance at expected value of optimal price if currency H is chosen. But if currency F, foreign currency, is chosen as an invoice currency, then the price in terms of home currency is equal to the expected optimal price in terms of foreign currency plus exchange rate. So the big difference between currency H pricing and currency F pricing is exchange rate pass-through. In the case of foreign currency pricing, there is 100% pass-through, as you can see here. Okay, the model is closed by monetary policy rule, nominal aggregate, which is assumed to be IID. So this is monetary policy shock. And nominal aggregate is given by price plus consumption. These variables are all in log terms. And with the assumption of log utility and complete asset market, exchange rate is given by the difference between monetary aggregate in home country and monetary aggregate in foreign country. So if there is a monetary expansion, increase in M, then exchange rate goes up, meaning currency depreciation in home country. Okay, this model is analytically tractable. So I can solve for the price level and also consumption. So which generates the answer to the first question, the impact of digital dollarization on monetary policy. Proposition 1, the impact of home monetary policy on home consumption decreases as more firms start using currency F as an invoice currency. So this situation is digital dollarization. So as digital dollarization deepens, as more firms set prices in units of currency F, then the impact of home monetary policy on home consumption decreases. The intuition is very simple. If more prices are set in units of currency F, then there will be higher exchange rate pass-through. The home consumption is given by home nominal aggregate minus home price level. So nominal aggregate increases. This is monetary expansion, but price level also increases because of a higher exchange rate pass-through under digital dollarization. So consumption response becomes smaller. Okay, so this is my first analytical result. So let me move on to the second question. Under what conditions can dollarization deepen? So to address that question, I need to consider invoice currency choices by firms and also households. So this is the invoice currency choice problems by firms. But the problem is very simple. Tradable goods firm I chooses currency H if doing so generates higher expected profits. So the currency choice problem, invoice currency choice problem is as simple as this. And this problem can be further simplified if this problem is approximated up to the second order. So the firm chooses currency H if the variance of the optimal price in terms of currency H is smaller. So this is very intuitive. So if the optimal price in units of home currency becomes less and less volatile, then it's very easy, become easier to hit the optimal price, even if firms have to set price one period in advance because optimal price becomes less volatile. Okay? So this problem can be solved analytically, and I need further assumptions. So I need to specify the pricing in other prices, like import and export prices. So here, I assume that currency F, country F, is a country with a dominant currency. That is, import and export prices are set in units of currency F. So under this situation, which currency, home or foreign, is used as an invoice currency in country H? So this is the question. So let me emphasize the importance of price-setting complementarities. If there were no price-setting complementarities, that is, no kink demand curve, alpha equals 0, no intermediate inputs, fees equal 0, then there would be no dollarization. So these price-setting complementarities are critical in considering the conditions of digital dollarization. So let me assume some degree of kinked demand curve and some degrees of intermediate inputs. So under this situation, home firms are more likely to set prices in units of currency F, so dollarization is more likely to occur as more tradable goods prices are set in units of currency F. So this is invoice currency choice complementarities. As country H becomes smaller, as country H becomes more open to trade, more wages are set in units of currency F, intermediate input shares become higher, and the degree of the kink in the demand curve increases. Under these conditions, digital dollarization becomes more likely to occur. Okay, this is my second analytical result. So let me move on to numerical analysis. So far, I have made many simplifying assumptions like IID shocks and one period in advance price setting. But here, I assume staggered prices and wage setting, a la Calvo and ASL, LR. And also, I assume persistent shocks following AR1 processes for productivity, monetary policy, and exchange rate shocks. And also, monetary policy rule is standard. The instrument is the short-term interest rate. Okay. So this is the extended model. And for the sake of the time, I need to skip parameter values, but the parameters are chosen to capture the main features of the average of the OECD countries, so advanced economies. Okay. The first is about the effects of dollarization on monetary policy. So look at this upper left figure. So this is impulse responses of monetary policy shock on consumption. And blue line is no dollarization, red line is some degree of dollarization, and black line, it's hard to see, but this is perfect dollarization. So as dollarization deepens, impulse responses of consumption to a whole monetary policy shock decreases and becomes zero. And opposite applies to the falling monetary policy shock. As digital dollarization deepens, the effect of falling monetary policy on home monetary policy, home consumption increases. And similar features are observed for productivity shock. And also there are other implications regarding country size and trade openness, but let me skip and discuss the second issue. Can dollarization occur? So this is the kind of a small but still numerical model. And this figure plots net benefits of choosing currency H. So if the value is positive, it means that the firms are willing to choose currency H. If the value is negative, the foreign currency is chosen. So please look at upper right figure, the impact of trade openness. So as the trade openness x-axis increases, the net benefits go down under the negative territory. So meaning that if the trade openness is large enough, dollarization would occur in the tradable goods sector. But looking at non-tradable goods sector and wage setting, labor market, values are all positive, so that in these numerical examples, dollarization are unlikely to occur in the non-tradable goods sector and wage setting. But if we consider the special case, like high trade openness, and also the home productivity shock is partly driven by foreign productivity shock, like global productivity shock, then there is a case that even non-tradable goods sector is dollarized. Okay. So digital dollarization is not far from reality. So that's the key message. Finally, I'd like to address the third question: what monetary policy can do about digital dollarization? Suppose that digital dollarization actually happens, and then this figure, upper left figure, plots the net benefits of choosing currency H as a function of monetary policy rule coefficient, inflation coefficient. So under the standard value like 1.5 or 2, so these are standard values of inflation coefficient in the Taylor rule, the net benefits are negative, so implying dollarization. But if central bank responds strongly to inflation, so stabilizing inflation, then the net values become positive, so that the central bank may be able to block digital dollarization by focusing strongly on stabilizing inflation. But if central bank focuses on stabilizing exchange rate, it may be counterproductive. As you can see that the net benefits become go down further. Okay. So let me conclude. So I addressed 3 questions. The first question is impact of digital dollarization on monetary policy. And the answer is that digital dollarization as digital dollarization deepens, monetary policy's capacity to stabilize the real economy goes down. And also, I clarify the conditions under which digital dollarization can deepen. And also, I show that monetary policy can block or facilitate digital dollarization depending on monetary policy goals. So I think time is almost up. So let me stop here.
Thank you, Daisuke. And not sure if my video's on, but this is Frank, the chair, and let's move on to the discussant, Arnaud Mehl. And yeah, thank you. I think you shared your slides. Let me just tell the participants or panelists if you can put questions into the chat, of course, type them in if you want to give Daisuke some time to think about it, or you can raise your hand and speak afterwards. All right, Arnaud, as discussant is Arnaud Mehl from the European Central Bank, and the floor is yours, Arnaud.
Thanks, Frank. Daisuke started with a disclaimer, so by symmetry, I'll do the same. So what I say, not necessarily what the ECB thinks, although it's not incompatible with what the ECB thinks necessarily either. So let me start the discussion by saying that I'm very pleased to discuss this paper for several reasons. One is that it was on my reading list, and I never got to read it, and now I had a deadline, so I could read it, which was nice. The second reason is that I'm super happy to meet Daisuke, which is I wanted to do that for a long period already, and now we have this occasion to finally see each other. And the third reason is that I liked a lot Daisuke's paper. It's extremely relevant not only for research but also for very concrete policy questions that, in fact, most central banks in the world are working on now. And the literature on the international implications of this new animal that is the central bank digital currency, or private digital currency could be, is very scarce. So it's very welcome that we have this paper today. And I enjoyed and learned a lot by reading from it. So Daisuke summarized his paper pretty well and several times. So I'll be short on that. But essentially, just the upshot about what the paper does. It looks at three extremely relevant research questions. First one is how digital dollarization affect the effectiveness of monetary policy. For central bankers, there's no better question than this one. It tries to understand why this could be the case, under what conditions a digital dollarization could happen. And then it looks at what monetary policy can do to block or catalyze digital dollarization. The basic setup of the paper is a classic DSG model. So two-country, neo-Keynesian model with nominal rigidities. It has home and foreign money, so two currencies as units of account. So the paper really focuses on the role of money as a unit of an account, not other functions of money, which is fine, but that's something which is important. Our digital money in the model is denominated in and pegged to the foreign currency. So think about a particular country which would be digitally dollarized by, say, DM, which is a private stablecoin, or the yuan, if those things come to life. You have home agents that can set prices and wages in units of the foreign currency frictionlessly. Frictionless is important here. And invoice currency choices, so which currency you choose, matters for the transmission of monetary policy and other shocks with nominal rigidities. Okay, so what the paper found is important. So it finds that your domestic monetary policy becomes less effective when you have digital dollarization, which is a problem. Digital dollarization is more likely to occur in small countries which are open to trade with tradable sectors and stronger input-output linkages. Hence, perhaps the quotation of Thomas Jordan was pretty relevant in that respect, I would say, to the extent that Switzerland is a small open economy which is open to trade and is involved in global value chains. And a strong stance of home monetary policy on inflation stabilization can block digital dollarization. So there is hope, in fact. So let me start with a lot of praise for the paper of Daisuke, and perhaps the biggest praise that I could make from a central banker to a central banker is to say that his research is very relevant for policy. And indeed, we had done a small report on central bank digital currency a few months ago, and when you read the report, you have in plain English what Daisuke basically shows much more rigorously in his paper. But let me read that out because it's quite striking. So the report at that time was saying, a significant adoption of money not denominated in the sovereign currency could limit the impact of monetary policy or the ability to support financial stability. That's another dimension. A risk of stable coins, so-called cryptocurrencies or foreign central bank digital currency, is that domestic users adopt them in significant numbers. You have digital dollarization, and use of the domestic sovereign currency dwindles in extremis. Such a digital dollarization could see a national currency substituted by another, with the domestic central bank gradually losing control over monetary matters. So lots of praise for Daisuke because it ticks all the boxes in his paper of that policy report, which was based how should I put it, more on thinking by the authors rather than solid research-based evidence. That's what Daisuke provides us with. So this is really great. Now, as discussant, I have to say something. So I'll say something, which are more, let's say, suggestions or philosophical points than let's say, real suggestions as to how to change the paper. But here's what I thought when I read the Daisuke's work. So the first question that I asked myself is, okay, we're talking about digital money here. What do we mean exactly by digital money, especially in the context of the model of Daisuke? So what we learn, or what we read in Daisuke's paper is that digital money is a digital unit of account denominated in and pegged in foreign currency, which is available frictionlessly. Now, the question that I ask myself, especially when I discuss with payment system experts or people who work on cryptocurrencies, do you need more structure here? Is digital money something very different, or let's say fundamentally different from other forms of monetary and financial instruments? And some would argue that yes, there are things which are conceptually different and perhaps you need to think about. So one is that obviously it's digital, so you have no physical storage costs. Another is that you have so-called bundling effects. The fact that I use a particular digital form of money, but it turns out that this is produced by a service provider like Facebook, which has other services that would link up my use of that currency with other things. The fact that digital money could be programmable, that payments could occur upon certain conditions and certain states of the world, which would be pretty different from the use of money, in particular banknotes, obviously, but other forms of money that we're used to have. And then you have also very innovative settlement methods. DLT, so distributed ledger technology, is one which is popular in the media now, but you have other settlement methods that are innovative and perhaps that changes the nature of money. And perhaps conceptually this needs to be reflected in our own reflections. Now let's turn to the macro effects that the Daisuke documents. So when you read the paper, perhaps the expression "all one in a new bottle" is too extreme, but you're bound to think like when I read that work, I mean it chimes with a lot of papers that we used to read in the 90s when I personally was a student, but where people had already thought about the effect of currency substitution on the monetary policy ineffectiveness. The monetary policy effectiveness, under real dollarization with fiat currency, with real dollars, on the role of of policy credibility, which is important and which was identified in that literature already 30 years ago. Now, there's a good defense that Daisuke has in his paper, and I think it's a very important and valid point. So Daisuke's work is mostly concerned with not the countries which were victims of dollarization back in the 80s and the 90s, but really like normal mature economies which are committed to stable to inflation, which have sound fundamentals and have, for instance, no fiscal imbalances. Now, the question that I ask myself is, that's a true point, but we never observed dollarization in this economy, at least not that I'm aware of. So to what extent are the macro implications for those economies which are not at risk of being dollarized could really matter? And I'd like to maybe this is something we could discuss as well with others. Okay, one thing which was important in the model of Daisuke, that's an assumption. We always have to make assumption. But one thing which is important or potentially important in the model is that digital money is available frictionlessly. So the question I ask myself is, suppose that home price and wage setters incur some costs by using digital money. as an invoicing currency. Would we see as strong effects as what we see in the current version of the paper? So obviously, the way we model those costs, linearly or non-linearly, would probably matter too. And then the empirical question is how strong, how large those costs would be. And that, I guess, would depend pretty much on the design of the digital currency itself. But I'd like to know what Daisuke thinks about that, and whether this is something that is potentially relevant. Okay, last point is on digital currency, it's always good to have a point which pleases payment system experts, because they love to discuss technical features which we as macroeconomists would subsume under just one parameter and say we're just busy with high-level questions. We don't want to discuss about those technicalities. But for payment system experts, those things do matter. So how about the technical design of digital money? To what extent this thing is just one parameter in our models, or whether there is something more to that that we need to think about? So, for instance, I'm thinking of the safety of digital money, whether it's backed by a central bank or not, with potential remuneration, or whether there are indeed some frictions. So, for instance, in international discussions about digital money, we hear a lot about whether limits to non-resident holdings could be something which one should consider. Some new forms of capital controls, for that matter. Whether the settlement technology could matter. I talked about this. Whether the digital currency is available only only online, but also offline. Whether that matters too. And as I said, these are hugely important questions in the policy and definitely in the research payment system literature. Okay. One question which I guess is a bit nerdy, so I don't have the answer myself, and I'm not really sure that's a relevant question. But one thing that struck me when I looked at one of Daisuke's equation, when it solved the invoicing currency problem, it reminds me of an old paper of Chris Sims and co-authors, I think 10 or 12 years ago. And I was wondering, in this equation, which is the Daisuke's equation, which is the one below, aren't we missing in the second round of mean solutions some other terms to get at the general equilibrium effects? So in Daisuke's equation, and that's really a question, I'm not sure I'm right here. I see terms only for prices, but not the volatility of all the other structural shocks. And confronting that equation with the equation that I remember from Chris Sims' work, and co-authors' work, 10 to 12 years ago, I was wondering, if we really want to get the general equilibrium effects, shouldn't we have other terms to get at those general equilibrium effects? And I'm not sure I have the answer. I'm not actually sure that the question is valid, but that's something that I would be happy to hear Daisuke's opinion on. Okay, I'll end shortly. Let me just do some shameless advertisement on what I did with some colleagues at the ECB on the international dimension of here CDBC. And just in a nutshell, I mean, our work is related, but somehow different from what Daisuke does. But what we essentially do is that if you want to understand the international spillovers that a CDBC could introduce, if it came in existence, I mean, what we find is that you need to think about new international arbitrage conditions between the CDBC and other internationally traded financial assets that exist, and in our we come to this nice parity condition, which is essentially the same as the one that you would typically have between, say, bonds or money market instrument, except for a couple of new terms which essentially reflect the intrinsic features of a CDBC in our representation, in our model, the fact that it is immediately liquid and immediately available for payments, unlike, say, bonds that you have to sell and that are subject to duration risk. This international arbitrage has very nice, interesting features because it leads to stronger international spillovers of domestic monetary policy shocks. So here I show you a chart with the TFP shock, but you can get the same with monetary policy shocks. Insofar as it amplifies the international channel of monetary policy for the reason that people tend to rebalance, or households, which are investors in the model, would rebalance much more into CDBC than in traditional international traded assets, simply because the CDBC has more attractive features. So you have these wider movements, which then translate into price rigidity, into real effects. Okay, I see Frank reappearing, so I think I'll be kicked out very soon. So I conclude now. It's a nice paper to read. It's one of the very few papers on the market on international aspects of digital currency. So that's great to have that. It's really truly innovative research. It's very intuitive to read. It has very appealing conclusion for policy. And it opens up, as always, many exciting avenues to follow. I'm pretty sure that I'll follow some, and that Daisuke will follow others in the future, and that we'll do things even jointly. Thanks a lot.
Thank you, Arnaud, for a really excellent discussion. We don't have too much time. I'm just wondering if there's some question from the floor before before Daisuke replies to your discussion. And let me I just want to second your opinion on now that this is like really policy relevant. We just had the BIS and the MAS. We co-hosted a conference that sort of was simultaneous with the ABFER. Some of you may have been in on it. The Sebastian Edwards gave a presentation, and I think what he was talking about with CBDC and dollarization was precisely the sort of what Daisuke was modeling what you're talking about. So it just really is something very relevant. On the other hand, I'll just mention this, and Daisuke, you don't have to answer it now because you have other questions, but there's this other question of the countries that are developing digital currencies, domestic digital currency, and what the implication of that is, as opposed to dollarization of their own economy. Sort of, and there's a question: do things just go in reverse if you develop your own currency and sort of drive out the dollar? Does everything go in reverse, or not? And, you may have a simple answer, or you may just save that for later. But if there's no questions, why don't I go back to you, Daisuke, and let you respond to this very, very interesting discussion.
Yes, Arnaud, thanks a lot for your insightful comments. So basically, I agree with all the comments, all the questions, basically 4 questions. And your first question is about the structure of digital money. So I totally agree with you. So in my model, the money is just a unit of account. Actually, there is no money. So cashless economy. And so this is a very extreme economy. And also using digital money is frictionless. Setting prices in units of US dollar in Japan is frictionless and costless. And so this is very, extreme situation. But thanks to this, extreme assumptions, I solved the model analytically and also derived some quantitative implications. And so this is just a very, very small step, first step, maybe a half or 1/10 step toward, understanding the impact of digital money or CBDC on monetary policy. And so we have more things to do in the future. And so I recently started my own project about digital money. And so, paper by Benigno et al. Using the 2 country economy model, but they regard money very seriously, so that the role of transaction and money as a store of value. And in that situation, the implications for monetary policy is drastic, very drastic. So I have some new idea, but here I'm still developing. And your second question is about, in a nutshell, old wine in new bottle. I partly almost agree, and so my answer is that, as you mentioned, I consider independent central bank, and there is also no fiscal imbalances. But the point is that no dollarization has so far hasn't occurred in these economies. So probably there are some costs. So this is associated with the third question. There are some frictions, there are some costs in setting prices in terms of US dollar in Japan or maybe in Switzerland or in European countries. And so my model abstracts away these details that could matter a lot. And so assume frictionless and costless digital money. And so that's the, I agree that that's extreme assumption, and we need to look at the reality, the detail of transaction and also payment systems in detail to nail down what's the cost and what's the potential the new digital money has to overcome these frictions. And finally, this is also related to my the comments made so far, but I agree that the technical feature of digital money does matter, and safety, and also as a store of value. And so these considerations has led me to start a new project about digital money, as I mentioned. So hopefully in the future, I have a little bit more answers for you, at least some of these very, very important questions. And finally, I greatly appreciate your technical terms. In this limited time, I cannot answer the question, but it looks very, very important. So I look into the technical detail later and respond to you. Thank you very much for your comments. Thanks a lot.
Thank you, Daisuke.